After outperforming the index by 10% in the fourth quarter of last year, we turned right around and did it again, outperforming the index by another 10% in the first quarter of this year. And in this video, I'm going to walk you through exactly how we did it. Now, for those of you who do not know who I am, my name is Stephen Brooks. I'm a hedge fund manager who specializes in systematic option strategies, primarily on the S&P 500. Now, if you're new to the channel, or this is your first video of mine, welcome. Our fund is not your average fund. We're not long stocks and short stocks. We actually don't ever buy or sell stocks. We don't do research on companies. We don't try to find these hidden gems with the potential to return, 10 times your money. We don't have an opinion on whether the market is going to go up or down, AI, crypto, none of that stuff. Instead, our fund sells short-term insurance on the S&P 500. Think about car insurance. Every month, you pay your premiums, and your worst case scenario is that you're out those premiums. Now, the person selling you that insurance is collecting those premiums every month, but their worst case scenario is your car gets totaled, and they have to write a check of $50,000, $100,000. That risk discrepancy between the buyer and the seller is known as convexity. And because the seller takes on that convexity risk, we have to build a markup into those premiums for providing that service. So all we do is we look for opportunities in the S&P 500 where we can sell insurance and charge a markup for that service. And that's really it at the 10,000 foot level. We do that 20, 30, 40, sometimes up to 100 times a day, depending on the day. And like an insurance company, we're doing the equivalent of selling life, car, travel, home, and maybe other types of insurance all in a single day. Except with us, every contract that we sell, every insurance contract that we sell expires at the end of the day at 4 o'clock when the market closes. Now, let's talk about what actually happened in the first quarter of this year. We were down 81 basis points in January, up 352 basis points in February, and up 381 basis points in March. Our Sharpe ratio for the quarter came in at 3.71, which I consider to be very strong. Our MAR ratio was 15.76, also very strong. Of the metrics we consistently track, the return is the only one where there's a little bit of disappointment. The Sharpe ratio and the MAR ratio nailed it. Very happy with those, but that return, a little bit disappointed. Now, a lot of you are like, dude, the market was down. It got smoked. We had a war. Oil went to 100. How can you be disappointed at all? Well, look, it's possible. We have a target based on our model of about 35% per year, regardless of what the market does. So at this point in the year, we're running about 200 basis points behind that target. Now, that's a little bit frustrating because there were definitely days throughout the quarter where we were very much on pace until late day news took the wind out of our sails. For example, a couple weeks ago on a Monday, I remember this too well. Around 3 o'clock, we were having our best day on record. And then at 3:10, I'm sitting there, and all of a sudden I hear on my platform, ding, 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 ding. And I look up and I see the market has rallied 100 points in 5 minutes because President Trump told some reporter that the war was going to end very soon. Now, ultimately, the market sold off 6% over the subsequent weeks because that wasn't necessarily true at the time. But moments like that happened a number of times throughout this quarter and were the primary reason that we're running a little bit behind target. Or truthfully, if 2 or 3 of those days didn't happen, we'd be ahead of it. But they did happen. And I'm not going to pretend that it's not even a little bit frustrating. Now, out of the strategies that we run, 8 out of 10 were profitable for the quarter, which is very much in line with the historical numbers. It's really rare for us to see a lot lower percentage than that in a given quarter. So when you look at the total picture, yeah, we're running a little bit behind our annual target on return, but the reason for that is very clear and very obvious. Our Sharpe ratio, great. MAR ratio, great. Our return to drawdown ratio, great. And the percentage of strategies performing well is right where we want it historically and right where it has been. Truth is, I wish those late day news didn't happen, but there's really nothing we can do about it. Now, the good news is the market will compensate for that moving forward in subsequent quarters when we're not dealing with a war or oil acting like a meme stock. Can we just talk about that for a second? Oil's the biggest commodity in the world, and for the last 6 weeks, it's been trading like GameStop. But because those things are unlikely to continue, we should be able to make up for the difference between where we are now and that target result. So if you are an accredited investor and you are interested in investing in our fund, there will be a link below this video that you can go ahead and click on to express interest. Or if you'd rather learn how to do this yourself and utilize our software that'll automatically place these trades in your account, there's also a link below this video for you as well.